Alright, what's up guys, hope you're doing well. James here from jamesdforsythe.com, and as you've noticed, I've been going through stablecoins a lot, talking about them mostly within the context of central bank digital currencies, right? And so basically, I've been going over speeches and such, mostly from Fed Governor Christopher Waller, because he's been rather outspoken about being against a central bank digital currency, especially with the Federal Reserve. And I think that's something that's important to kind of continue to go over because at least it's more anecdotal. But for me, I've noticed the vast majority of that kind of talk from kind of these public officials, it seems, at least from what I've seen, has been more towards for it. So to find an opinion against it, to be completely honest, he's the only opinion from that respect, especially with respect to the Federal Reserve and those officials that's been outspoken about it. At least from what I found. Again, anecdotal. So that being said, I'm going to, and as promised in previous videos, going over the president's working paper that he cited a few times in his speech and that sort of thing. And so it's basically just the report on stablecoins. And I wanted to start out with just kind of a basic 101, kind of what are they, what do they do, that sort of thing. Kind of a little bit of nuances in it, so hopefully it'll be a shorter video. We'll find out from what I normally do. But to keep that in mind, again, the link to the report itself will be in the description. As always, I always put sources in there that I find, as well as anything else that seems relevant or helpful to the video topic. So anyways, to start with, so stablecoins are generally created or minted in exchange for fiat currency that an issuer receives from a user or third party. So either like some form of entity that they're working with, whatever the case may be. Obviously, there's multiple types of stablecoins out there, and there's multiple stablecoins themselves within each kind of category. And so one thing that I've noticed, it's really like they seem to be like they're companies, and each one is like a company, and you see it as a kind of a broad range of them, that there's differences in each one, and you really have to kind of take it from a case-by-case basis from what I've noticed. So that third party can either be one of the companies, whatever they have their setup as, or an individual who actually uses it or buys the stable coins, right? And so to maintain a stable value relative to fiat currencies, many stablecoins offer a promise or expectation that the coin can be redeemed at par upon request. So they're called stablecoins for reasons because they're generally pegged to some form of reserve asset or a basket of reserve assets, and that's kind of your typical, I think they call them convertible stablecoins. There's other types as well, such as algorithmic. For some reason I can't talk this morning. Seems to be a trend. But anyways, basically, like with the ones that basically just follow an algorithm, it seems like they just kind of trade in such a way that they maintain a relatively stable value of whatever that value is supposed to be. And then there's also the ones like, for me, I think it's a pretty good analogy to compare stablecoins to like foreign currencies, especially ones that are pegged to the US dollar from that perspective, because it's really kind of the same thing in practice, it seems. Maybe not in practice, but the same kind of concept, keeping it pegged to some reserve asset or some currency, right? Like a foreign country holding dollar reserves for whatever reason. Like you kind of see that with Japan right now, how they keep basically buying dollars and not buying dollars, but releasing their foreign reserves. I'm sorry, selling dollars to basically try to help their currency not collapse against the U.S. dollar in general. And so just kind of keeping that in mind as an example. But yeah, so anyways, currently it seems there are no standards regarding the composition of stablecoin reserve assets, and the information made publicly available regarding the issuer's reserve assets is not consistent across stablecoin arrangements as to either its content or the frequency of its release, right? So pretty much no standards, it seems, in that respect, or at least I guess governmental standards. And this may be why, or where you're starting to see from the kind of officials, we'll say like Federal Reserve officials, where they keep touting like, same use, same regulation, and that whole kind of concept of where it's supposed to be like, if a digital asset has the same use or in practice is used the same way as an analogous traditional financial asset, then then that digital asset should undergo the same types of regulations as that traditional financial asset, right? And to keep that in mind, making sure I don't miss anything. That's pretty much not. Basically, just going into different types of stablecoins and stuff. Trying not to lose my spot. But then this kind of goes into, say, redemption rights and stuff, because that's kind of the whole point, right? To where you can use these stablecoins as a way to kind of move through kind of the digital asset kind of trading realms, it seems. Basically, whether it be through different trading firms, use them for specific purposes, whether that be like more of a DeFi sort of thing or whatever, you have to redeem them at some point. And so keeping in mind how this could be a little bit different, and so stablecoin redemption rights can also vary considerably in terms of both who may present a stablecoin to an issuer for redemption, and whether there are any limits on the quantity of coins that may be redeemed, right? And so some issuers are permitted under the terms of the arrangement to postpone redemption payments for 7 days or even to suspend redemptions at any time, giving rise to considerable uncertainty about the timing of redemptions. And so this really brings to mind, at least for me, the need to you really have to read the fine print with these sort of things. And this gets into the whole FDIC insurance that you have, or I think this was a big problem for one of the stable coins, and I forgot which one it was specifically. But basically, so it's like the stablecoin issuer had their reserve assets deposited in an FDIC insured account or whatever it was, right? Basically, the reserve assets were FDIC insured, right? But that doesn't necessarily mean the people who own the stablecoins have the FDIC insurance. They have to have something called pass-through deposit insurance coverage, right? So basically, without this kind of pass-through deposit insurance coverage, the user does not have the FDIC insurance. The issuer of the stablecoin does, but not the user of the stablecoin. And so basically, it seems like they would need that the issuer has to have that pass-through coverage in order for that insurance to pass through the issuer to the user. And it seemed like basically people were getting confused with this specific company, that basically that was the case to where they didn't have the pass-through coverage. And so basically the users thought that they had the FDIC insurance, and so they were more apt to partake in using the stablecoin. But without that pass-through coverage, they quickly find out that they didn't have it, right? And so, and I believe with that one specifically, it was like, I think they ended up getting screwed on that one. That may have been one of the ones that collapsed, but again, don't quote me on that. I don't know. At least enough to be very convicted about it. So anyways, especially with stuff like this, and you should do this in general, is just kind of like actually fully understanding, especially if you're going to put any significant amount of capital on something, you should really read the fine print and really look into it regardless. And so really try to understand what the dynamic at play is, whatever it happens to be, with whatever company, firm, whatever. So just kind of a quick note on, because one of the things that we've been doing as we've been going through these videos is really drawing the analogy between stablecoins and commercial bank deposits, right? On how maybe in practice they're kind of similar in that respect, or they can be used in a similar way. And with that, you kind of have to look specifically at the stablecoins that are for retail payments, right? And that kind of settlement in a way. I don't want to say stablecoins and have people lump all of them into that group, because that's not really accurate, especially with like well, maybe, but you really have to look at the purpose of the stablecoin itself and what it's being used for, especially with respect to if it's being used for retail payments and that kind of the settlement of those kind of retail transactions. then in practice it does kind of, it seems to be much like a commercial bank deposit, just kind of slightly different. And so keeping that in mind, and we've kind of reiterated this a few times throughout a few different videos, but essentially a demand deposit held at an insured depository institution is a claim on the issuing bank that provides the depositor with the right to receive US dollars upon request. So in that way, it's very similar to stablecoins, to where instead of an insured depository institution, you have whatever the institution that's issuing that stablecoin, right? Where you're buying the stablecoin, right? And you're basically, especially the ones it seems that are backed by reserves or a basket of reserve assets, that basically you have the claim, the stablecoin, on the issuing firm, whatever the company is, that provides you with the right to receive whatever that reserve asset is, or equivalent of whatever your claim is through the stablecoins whenever you want to redeem it, right? Which is why we went over redemption rights a few seconds ago. So the value of this claim is insured up to a certain amount and entitled to depositor preference in resolution. And that last statement is with respect to demand deposits at your commercial bank, right? And so that the problem with this is, with respect to stablecoins, is that, as we've been discussing, don't have that typically, or at least it's not insured or guaranteed to be insured, right? And that's why it's important to distinguish between the insured depository institutions for demand deposits, and then the actual, like the stablecoin issuers and that whole pass-through coverage we talked about a second ago. Because without that, you're not actually insured, and this kind of gets all thrown to the wayside. And kind of another comment on it is but with these depository institutions, going back to commercial banking and the more traditional finance, right? So basically, they have access to emergency liquidity, and basically because of that, since they have access to that, they also have to undergo supervision and regulation and stuff from the Federal Reserve and other, we'll say, executive entities, just to kind of, for sakes of time, right? And then basically this is all designed to limit the riskiness of the issuer's balance sheet and operations. So basically all of the regulations and supervision commercial banks and depository institutions have to deal with, and that's kind of intrinsic in their being allowed to partake in the Federal Reserve System. And we don't have an analogous system like that for stablecoins, right? Which is the whole argument for the working paper. And we've discussed this a few times in a lot of the Federal Reserve speeches, as this has come up, mostly from those from Fed Governor Waller. And so keeping that in mind, and that's really the whole kind of point with this. And kind of drawing this analogy is, it seems like you're seeing, I wouldn't say all the benefits, but in practice, the use for a stablecoin is for retail payment settlement, again, to make that distinction. And there it goes. But basically distinguishing the demand deposits. I'm not articulating this well. My apologies. So basically, again, the stablecoins for retail payments are showing in practice the same use as demand deposits from depository institutions, your commercial bank checking account, right? But they're not showing all of the backups and all of the kind of government, I don't want to say subsidies, but how basically the government's backing it. Basically all the safeguards. I think that's a much better word. All of the safeguards you get from insured depository institutions, you don't get with stablecoins. And that's kind of the major selling point for more regulations on stablecoins, right? And I went over this relatively in depth from one of the speeches from Fed Governor Waller, where he really went into it in terms of how he thinks stablecoins show promise in this respect for being used as a kind of a competitive system to traditional finance in that respect, meaning the commercial banks, and that kind of, in using the stablecoins as that kind of retail settlement mechanism. And basically, with that being said, they also should have the backstops and safeguards necessary to basically protect consumers in that respect. That seems to be the entire argument. But regardless, and that's basically it for this one. Just kind of basics for the creation and redemption of stablecoins in that respect. Pretty much just to kind of discuss it and put it out there, because it is something that's, especially with the pass-through coverage, you really have to look at the nuances and understand what you're dealing with. Regardless, it just kind of brings you back to the whole era of free banking in a way, to where the banks didn't necessarily have all the safeguards and regulations. That basically what's happening now is with these financial institutions, regulators and more or less the government is auditing and basically thinking of a word for it, making sure that the institutions are safe and sound for your money without you having to do it yourself. Whereas in like the 1800s and free banking and that sort of thing, it was up to you to do that. But now it's like the government's doing it for you in a way. And not here to argue the advantages or pros and cons of any of that. I'm just kind of making a statement in general. But anyways, I'm going to leave this one here. So with that being said, I hope you guys have a good night, and I will see you on the next one.